centuries, the trap of speculative investment and the loss of hard-earned money. Every generation believes it is smarter than the last. One of the most dangerous thoughts in finance is this: this time is different. It appears whenever a new technology, asset, or system captures public imagination. Each generation believes it has learned from past mistakes, that old bubbles were the result of ignorance, and that modern tools have eliminated the risks that destroyed earlier investors. History tells a harsher story. The instruments change. The language evolves. The charts become more sophisticated. But human behavior remains stubbornly unchanged. Speculative manias are not accidents. They are recurring patterns, replayed whenever hope, storytelling, and easy money intersect. Tulip mania, when flowers became fortunes. In the 17th century, tulips became objects of obsession in the Netherlands. Rare bulbs were traded for sums that exceeded annual wages, homes, and land. People did not buy tulips to grow flowers. They bought them to sell at a higher price. The logic sounded familiar even then. Tulips were rare. Demand was rising. Prices had only gone up. Those who hesitated felt foolish as others seemed to profit effortlessly. Contracts changed hands multiple times before a single bulb was ever planted. Value became detached from utility. When confidence cracked, prices collapsed almost overnight. What remains remarkable is not the absurdity of trading flowers for fortunes, but how rational it felt to participants at the time. They were not reckless gamblers. They were responding to social pressure, visible success, and the belief that opportunity rewards the bold. The dot-com bubble, when ideas replaced earnings. Centuries later, technology replaced tulips. In the late 1990s, internet companies flooded markets with promises of a new digital future. Profit no longer mattered. Revenue was optional. What mattered was being early in something revolutionary. Companies with no earnings commanded astronomical valuations. Investors were told that traditional metrics were outdated and that skeptics simply didn't get it. Stock prices soared on expectations alone. When reality returned, it did so brutally. Trillions in market value vanished. Careers ended. Savings disappeared. Yet even after the crash, the lesson many people absorbed was not caution, but timing. They believed the mistake was not speculation itself, but entering too late or exiting too slowly. That belief would resurface again. The housing bubble, when safety became speculation. Housing was once considered the safest investment imaginable. People believed property could only rise in value. This belief was reinforced by easy credit, complex financial products, and institutions that treated risk as something to be repackaged rather than reduced. Homes stopped being places to live and became vehicles for leverage. Ordinary people borrowed heavily under the assumption that rising prices would protect them. When prices stalled and reversed, the entire system cracked. The 2008 crisis was not just a financial collapse. It was a psychological one. People discovered that assets labeled safe could still be speculative when driven by belief rather than fundamentals. Crypto and meme assets, speed, screenshots, and stories. Modern speculative manias did not invent new psychology. They simply compressed it. Cryptocurrencies, meme stocks, and digital tokens move faster than any asset class in history. Gains and losses that once unfolded over years now occur in days or hours. Social media acts as both amplifier and accelerant. What makes modern speculation uniquely dangerous is not just volatility, but accessibility. Anyone with a phone can participate instantly. There is no barrier of education, experience, or reflection. Screenshots replace balance sheets. Influencers replace analysts. Communities replace accountability. The narrative remains unchanged. Early believers win, skeptics regret, and late entrants provide liquidity. The recurring pattern. No one wants to admit, across centuries and asset classes, speculative manias follow a familiar arc. It begins with a compelling story. Something new, rare, or revolutionary captures attention. Early participants benefit, reinforcing belief. Media coverage amplifies success. Skeptics are mocked. Caution is reframed as fear. As prices rise, participation broadens. Ordinary people enter not because they fully believe, but because they fear being left behind. Risk is normalized. Leverage increases. Warnings are dismissed as outdated thinking. Eventually, reality intrudes. Growth slows. Confidence wavers. Selling begins quietly, then suddenly. What looked like opportunity reveals itself as imbalance. The crash is not always dramatic. Sometimes it is slow, grinding, and emotionally exhausting, but it is almost always devastating to those who entered last. Why knowledge alone never stops a bubble? Each generation has access to more information than the last. This has never prevented speculation. Why? Because bubbles are not fueled by ignorance, they are fueled by belief. Information competes poorly against hope, especially when hope is rewarded temporarily. When people see others profit, warnings feel abstract. Risk feels theoretical until it becomes personal. Speculative manias do not require people to be wrong about everything. They only require people to be wrong about one thing: the assumption that they will exit before others do. The quiet winner's history rarely mentions history, often focuses on the dramatic losses, but rarely on the quiet winners. These are not the loud promoters or late participants. They are those who entered early, exited quietly, and left the story before it turned painful. They did not necessarily predict collapse. They simply understood that speculation rewards position, not belief. This asymmetry is what makes speculative markets so dangerous for ordinary participants. The system does not collapse equally, it redistributes. Why every crash is followed by amnesia. After each speculative collapse, there is outrage, investigation, and regret. Promises are made, lessons are declared learned. Then time passes. A new generation enters the market with fresh optimism. Old charts feel irrelevant. Past warnings sound pessimistic. The belief that this time is different returns quietly, wearing modern language. Memory fades faster than risk. The uncomfortable truth history teaches us. Speculative manias are not caused by bad people or bad technology. They are caused by a mismatch between human psychology and systems that reward speed, confidence, and belief over patience and value. History does not repeat itself because people forget facts. It repeats because behavior doesn't change.